Hello, everyone. Welcome to the weekly roundup. Today we will cover monetary policy, tariffs, and the global economy. Hello, Ben.
Hey, Eva.
Nice day downtown.
Sunny, but it's shockingly cold when you go outside.
Oh my God. And so it
Yeah,
begins.
yes, it does.
Okay, let's get right into it. Powell earlier this week says there's no risk-free path for monetary policy. Are we seeing a tilt towards cushioning the job market at the expense of inflation control? And what does this mean for future rate moves?
Yeah, so that's a great question and point. I mean, I think that what Powell's effectively saying, yes, is that the jobs number is probably the most important thing that they're looking at right now. One of the challenges that we have with data is the government shutdown. So the government shutdown was effective October 1st. So the next Fed meeting is coming up, as you know, October 29th. So if they don't have any data to use, they're probably going to continue on their path, which is future cuts, no matter what, if they don't have the numbers that they want. So I think, yes, the key focus is the job number. I think that's the same in Canada as well. I think they're focusing on that over inflation. And when this tariff started, I hadn't really thought about it from this perspective, but I think we've subsequently talked about it a few times, is that it appears that the tariffs are causing inflation in the US and deflation elsewhere. And if we look at those numbers, certainly in Canada, that seems to be the case because we have our inflation's falling much faster than it is in the US. So I think your point's right. I think that the jobs number is the key data point that they're watching now.
Okay. Some interesting news that came across during the week. Treasury officials indicated that the Trump administration is considering setting price floors across a range of industries to counter China's market tactics. Um, could this raise costs for consumers and, could this further escalate global trade tensions?
Oh yeah. I think Trump likes to think of himself as a free market leader, but any of his actions so far has been the opposite of a free market leader. So, you got to put in floors. What's that going to do? That's going to have knock-on effects everywhere. So for the most part, a lot of the companies have been eating any cost increases, but if you force them into a corner where they have to decide if they're going to continue to be able to survive or not, then they're going to raise prices. So I don't think setting parameters around what people have to charge or should charge, or putting these floors and tactics in place, I think doesn't let the market decide. So I think, personally, I think it's a terrible idea. As far as going to put pressure on the U.S. consumer, I think yes, at a time where they probably don't need more pressure. I know we put up the chart last week about, household net worth is at all-time highs in the US. That's still for a small sliver of the US population. It's not the masses. And so putting floors on, I think, puts more pressure on the masses. So yeah, I think it would be very inflationary.
Okay, speaking on trade, the World Trade Organization raised its 2025 trade growth forecast, but it gave a caution about 2026 looking much weaker.
Yeah.
What is foiling the short-term optimism, and how could this 2026 forecast affect global economic growth?
Yeah, so I think that the optimism has just been around. I guess there was this fear that this trade war would steamroll into causing kind of runaway inflation, higher rates, just kind of pressure on an already healing economy. So I think that's been less damaging than originally expected. So you were talking about 25, 30, 40, 50% tariffs. If those things actually went into place across the board, that would put massive pressure on people. But it hasn't played out that way. It's been more of like a 5% across the world increase. pressure, we'll say. So that coupled with financial conditions getting easier has probably resulted in a surprise to the upside for GDP. So if you look at like money supply, which we talk about a fair amount, has increased, but generally ECB's been cutting. Bank of Canada cut until they took a little break and they're back to cutting. And now finally the last one, which is the US, is into cutting mode as well. So I think financial conditions getting easier resulted in better GDP numbers globally.
Okay, back to rate cuts. Markets are currently expecting a cut in this October meeting, another in December, and possibly three more next year. How is this easing cycle going to shape investor sentiment and, general market direction going forward?
Yep. So I think that's a great question and point. And I think, as you referenced with WTO, talking about what 2026 will be like, and it'll be more of a challenge. Potentially, I think it's, where a lot of economists like to look in long cycles, flat line returns up or down, nothing ever cracks. It's hard to glance off into the future 12, 16, 18 months. So I think that the reaction of the central banks to how the economy is evolving will be very important next year. So to your point around the rate cuts, yeah, it looks like we'll see another two in the US and then three or four next year. I think three or four next year are completely contingent on what happens to the economy, the jobs numbers over the next short period of time. We have May of next year where there'll be a new head of the Federal Reserve in the US and Chair Powell will be gone. So if the likely outcome is a Trump-friendly chair of the Federal Reserve, you probably could get five, six, seven, eight, depending where and how aggressively they want to push this thing. As you know, end of next year we have midterms, so that plays a part too. The Republican Party will want to continue to maintain as much power as they can, so making the financial markets pretty rosy by election time will be, I think, part of their goals and objectives. So if there was nothing done and we went through a normal cycle, I think that's right. 2026 could be challenging economically. And so I think we'll see. We'll see. But I think, greater question is what's that mean to the markets? I think that it could mean a number of things. Certainly, maybe we bubble up more in equities and they get a little bit further extended. But then on the, I think, more important side is what happens to rates. So if we see bond rates start to move lower, that probably helps the economies of the world kick the can down the road a little bit farther. So, instead of a 5 year or instead of a 5% 10 or 30-year bond in the US and Canada, you get a 2 or 3%. It actually makes financial conditions a bit better for the governments, and maybe they kick the can down the road a little bit further. So, I think there's lots to consider, but rates right now where they are could have an impact for what happens to markets and the economy next year.
Sure. Let's see the charts.
Okay, so we are recording this around 1 o'clock on October 16th. And so, of course, anything that gets covered in the markets and media between now and then, we'll comment on next week as well as we can. As always, if there's any questions that you have around some of the things we talk about as well, please feel free to reach out to us at the time. So you mentioned some economic forecasts off the top there. This is our most recent from our economics team, and broke down by advanced economies and emerging economies. I think it's a good way to look at it. And so you'd look at Canada there, forecast same as this year, which 1.2%, 1.2% forecast for next year as well in Canada. Again, I think these are all contingent on how the things play out short to medium term. In the US, again, forecasting pretty similar returns. Overall, you're looking at advanced economies, similar return profile for the economic activity next year. If you look at the emerging countries, I think China, that's an important one to watch because if we see a de deceleration into 2026, that will be certainly a drag on the global economy. India as well, slight deceleration. Mexico, pretty similar, actually slight acceleration. So, I think there's a lot to consider for 2026. But I think easing financial conditions is really the biggest reason why I think WTO, you mentioned, revised their forecast for economic activity. So this isn't the market, this is the economies. They are connected, but not one and the same. So I think important just to think about what and how that might look as we go forward. So this is to your point and your question off the top, Eva, is what does the employment number look like, and does that have an impact on what the U.S. Central Bank does? And so I thought this was a great chart. I hadn't seen it delivered this way, but this is a good snapshot for U.S. young people bearing the brunt of the labor market weakness. And so if you look at this 20 to 24, this is a really important demographic of people coming out of university and starting to get into the workforce. Now we're starting to creep up to, close to those 10% levels, which is much more like European unemployment in that age group. So if the US is starting to see that, they graduate a lot of people every year. If they have no place to go into the workforce, that's increasing some of the risks in not only the economy, but some of the risks in the civil unrest that the US is going through right now. So I think this will be a key point to pay attention to and be conscious of. And this is a little bit more detailed on our expectation for where rates go over the next little while. So again, I think this forecasting is great, just given on best case scenario, but we've had so many changes over the last many years that I tend to look maybe 2 quarters at a time ahead and say, what does this look like? So if you're on the US here, you're looking at October 15th, so target 4.25%. We have the next meeting coming on the 29th of October, so it's all but priced in a 25 basis point cut. So you'd expect that to go to 4. And then in the last meeting of the year, expect that to go to 3.75. And then as we get down, we're kind of flatlining out into that 3.5 by the Federal Reserve. I think this is more of a tilt towards let's see what happened when Powell is removed and there's a new Fed chair in, and we'll take a look at what the numbers look like that way. From Canada's perspective, there's many things to look at, but this is what most people probably pay attention to, which is the target or the overnight rate. And so right now in Canada, we're at 2.5. So we are pricing in another 2 cuts. Maybe it's 1 cut of 50 basis points or 2 of 25. That we're expecting another 2 cuts before the end of this year, and then sticking down around that 2% level. And so I met with a number of mortgage advisors yesterday, and we're asking about this, what does it look like? And, I think my response was, we're probably close to the end of the cycle. Does this stop at 2? Do we go to 1.75? Do we stop at 2.25? I think we've come close to reaching the bottom of the current cycle from an interest rate perspective, certainly on the short end. And that I think would be quite key and important to pay attention to. And has many knock-on effects to the economy and borrowing costs and such. But I think Canada is closer to the end of that, and a big driver for where and what happens from here. I think a lot has to do with that employment number, and we'll have to keep watching that. Canada had an employment number beat last week, but their data has been extremely choppy. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. I prepared this research and documentation myself. If you have any questions, please feel free to reach out to me or your advisor. Everyone's risk profile is a little bit different, so some of the things we talked about today may not be appropriate for everybody.
Thank you, Ben.
You're welcome.
What's on the agenda for next week?
So I think for Canada, probably the biggest thing we should pay attention to is CPIs on Tuesday. And so I think that will be a big driver of whether they cut or not October 29th. So in Canada, I'd be watching that quite closely. Right now, we still anticipate they cut, but that would be a big piece to watch. If there's a surprise to the upside, then no cuts. Surprise to the downside, then a cut probably locked in. So I'd say that'd be the big one to watch in Canada. From a market perspective, I continue to watch to see what to do with precious metals and gold. Gold's continued up and over that 4,000 level now for quite some time. Some of these stocks have run quite a bit higher than expected. So I'd be watching that and saying, what do we do, if anything, at this point? We've had a couple of failed rallies in the big picture of the market this week. So, we had a nice open today, and then we're trading down now into early afternoon, and so that's tends to be a bit of a sign that maybe the market's getting a little bit tired. So I'd be watching to see if that continues. But generally speaking, from an economic perspective, what's the inflation number in Canada? And in the US, the thing we'd watch is when they finally come to an agreement so that they can move forward and get back to work and get rid of this self-imposed cap that they have with their debt levels. Because right now, the longer they stay in this kind of lockdown period, the longer the data gets muddied, and it's not a great time for that to happen.
Yeah, that's the focus on. Thank you. Thank you everyone for listening. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you everyone and have a good day. Bye.
Thanks. Take care.